Most people believe there's a perfect moment to invest, the right entry, the perfect bottom, the ideal time when everything finally makes sense. So they wait. And while they wait, the market moves on without them. This is the difference between timing the market and time in the market. And it's one of the most expensive lessons investors ever learn. On paper, timing sounds smart. Buy low, sell high, avoid crashes, skip losses. It feels efficient, controlled, and skillful. It feels like you're being strategic instead of reckless. But the market doesn't reward what feels logical in your head. It rewards what works over time in the real world. Here's the problem with waiting for the right moment. The right moment never looks right while it's happening. When prices are falling, it feels dangerous. When prices are rising, it feels expensive. Fear blocks action at the bottom, and greed pulls people in at the top. Human psychology is literally wired against good timing. Market bottoms are invisible in real time. You only see them clearly in hindsight, months later, after prices have already bounced. In the moment, the bottom feels like the beginning of something worse. Headlines are negative, confidence disappears, and fear feels rational. People don't think, this is the opportunity. They think, what if this drops another 30%? So they stay out, waiting for safety, and safety usually arrives only after the opportunity is gone. And at the top, the opposite happens. Market highs feel safe. Optimism is everywhere. Everyone has an explanation for why things will keep going up. Confidence feels justified, risk feels invisible, and people tell themselves, this time is different. That's when timing fails again, because the same psychology that prevents buying at the bottom encourages buying near the top. This creates a brutal cycle. People avoid markets when prices are low because they feel scared, and they enter markets when prices are high because they feel confident. That is the exact opposite of what successful timing would require, and it's why most market timing isn't just difficult, it's psychologically unnatural. Another thing most people don't realize is how expensive it is to miss just a few of the market's best days. Long-term returns often come from a surprisingly small number of powerful up days, and those best days tend to happen during chaos, near bottoms, and right when fear is highest, exactly when people are most likely to be out of the market. So the investors who try to time the market are often the same investors who miss the days that matter most. That's why doing nothing feels safer than making mistakes. Inactivity feels calm. There's no immediate regret, no visible loss, no painful "I messed up" moment. But inactivity has a hidden cost. Every day out of the market is a day compounding doesn't work for you, and compounding doesn't wait. It's either working or it isn't. Time is the only edge that works reliably because you can't consistently predict markets. No one can. Not analysts, not experts, not algorithms that depend on human behavior, and definitely not someone reacting to headlines. But you can control one thing: how long you stay invested. Time smooths volatility. Time absorbs mistakes. Time gives your investments a chance to recover, grow, and compound. That's why the market rewards endurance, not precision. The market does not reward perfect timing. It rewards people who stay, people who remain invested through uncertainty, noise, bad headlines, and fear. Endurance beats accuracy because accuracy requires you to be right repeatedly, while endurance only requires you to not quit. Even smart people fall into this trap. They believe they can spot signals. They analyze charts, watch indicators, read sentiment, and wait for confirmation. But confirmation usually comes after prices move. By the time it feels safe, the market has already climbed. So they buy late. Then the market pulls back, they panic, they sell, and they promise themselves they'll get back in later. This is the most common lie investors tell themselves. I'll step out now and re-enter later. Because later is vague, and re-entry is emotionally harder than entry. When you exit, you start waiting for clarity. But clarity doesn't arrive in a neat package. Markets don't ring a bell when fear is done. The news remains mixed. Someone always predicts another crash. And while you wait for a perfect signal, prices drift upward. Then you feel frustrated and you wait for a dip. The dip comes, but it feels scary again. You hesitate again. And then years pass. The market doesn't care about your plan. It doesn't move on your schedule. It doesn't pause while you decide. It moves when it moves. And the market's biggest gains often happen when confidence is lowest, which means the market rewards the people who can stay invested when it feels uncomfortable, not the people who wait for comfort. Long-term investors understand something simple. Uncertainty is not a problem to solve. It's the price of admission. They don't try to avoid every loss. They don't try to dodge every downturn. They accept volatility because volatility is the reason returns exist. If markets were smooth, safe, and predictable, the returns would shrink because everyone would pile in without hesitation. The discomfort is what creates the opportunity. And here's the math behind staying invested. The longer your time horizon, the less volatility matters and the more compounding dominates. Time turns randomness into trend. Short-term chaos becomes long-term growth. What looks like a roller coaster on a 1-year chart often looks like a steady climb on a 20-year chart. The moment investing becomes about prediction, it stops being investing. It becomes betting. Betting requires you to be right repeatedly. Investing only requires you to be patient. This is why consistency beats brilliance. You don't need perfect decisions. You need consistent participation, regular investing, long holding periods, and minimal interference. That's it. The simpler the process, the fewer opportunities your emotions have to sabotage it. So what is the real risk of market timing? The real risk isn't losing money temporarily. Temporary losses are normal. The real risk is missing years of growth, sitting in cash while assets rise, and never getting fully invested because you're always waiting for the right time. That damage compounds quietly. It doesn't scream at you, it just steals your future. Time in the market does something that timing can't. It allows bad entries to recover, mistakes to fade, and growth to stack. Timing demands perfection. Time demands patience. Timing asks you to predict the future. Time asks you to endure the present. The best investors aren't fast. They're calm. They don't rush in. They don't rush out. They let the market do what it has always done over long periods. Reward those who stay long enough. Timing the market feels like control. Time in the market feels boring. But boring works. You don't build wealth by predicting the future. You build it by staying invested while the future unfolds. That's the difference, and it's the difference most people only understand after they've paid for it.